investors may use our discretionary investment idea summary to implement a customized version of KISS. So in terms of how to incorporate or how to interpret this table, so what we are looking at is the top-down market regime. We are currently in Goldilocks, as indicated by our top-down risk management by our global macro risk matrix. That's what determines what regime we're in. I got a great question in our 42 macro aware community about the dichotomy between the bottom-up grid regime projections, i.e. what the economy is projected to do from our econometric tools, versus what the markets are currently doing based on our global macro risk matrix. In our opinion, we think it's a much more valid process, and you're likely to have better, more consistent results over time by orienting your portfolio to the top-down market regime, as opposed to doing what I think a lot of other investors are doing, which is constantly trying to predict what's going to happen in economy and putting positions on that correspond to those predictors. Obviously, there's a tremendous amount of forecast error from my perspective. I've never seen so much forecast error amongst the investor consensus. In fact, let's play a game. Everyone raise your hands. Put a hand up. Put a hand up right now. Keep your hand up if you forecasted the 2020 pandemic. Obviously, most people should put their hands up. Keep your hands up if you forecasted the government will spend $6 trillion in a panic response to the pandemic and have the Fed monetize 50% of that $6 trillion. Keep your hand up if you also realize heading into 2022 that not only was the Fed funds rate way too low, but it would be hiked at the fastest pace to the highest level that we've seen in 40 years in both instances. Keep your hand up if at the end of 2022, you thought there was going to be a surge in global liquidity that propelled asset markets higher into the first part of 2023. Keep your hand up if you saw the regional banking crisis coming. Keep your hand up if during the regional banking crisis, you bought stocks and bought at-risk assets because you understood the liquidity response or you understood that the economy was going to remain resilient despite all the negative headlines at the time. Keep your hand up if you also called for the bond market blow up in the middle of the year that itself was perpetuated by U.S. fiscal policy dynamics, tightening Bank of Japan policy dynamics, sort of things of that nature. And then lastly, keep your hand up if you also called for the pain trade at the beginning of November higher in stocks that left a lot of investors in the dust. That's a lot of stuff to forecast. And I'm guessing that a lot of you don't have your hands up at the end of that process, right? That's what's happened over the last 3 years. And so if you go back and you try to project your ability to consistently predict what's going to happen in the economy or consistently what's going to happen with policymakers as your core basis for putting on and taking off positions in financial markets, after having just gone through that exercise, looking backwards at your ability to not predict, your inability to predict over the last 3 years, if you didn't learn something from that exercise, you are not doing your job as an investor to make yourself a better investor and produce better outcomes for your family or to produce better outcomes for your clients. This stuff matters. So let's get back into our discretionary investment idea summary. So how this table is organized, it's organized by asset classes, equity factors here, global equities, fixed income sectors, macro exposures. It's got our current volatility adjusted momentum signal for the particular ETF, the 14-day RSI for the ETF. And then here's where it gets interesting. The model itself will recommend a specific action for an investor to take based from today, not from yesterday, based on today's current interplay between the volatility adjusted momentum signal, the RSI, and the current top-down market regime. And so how this works is if the ETF is bullish or bearish from the perspective of our volatility adjusted momentum signal, and it should be bullish or bearish in this particular grid regime, then the model will recommend a long max position or a short max position, depending on if it's bullish or bearish. And if an ETF is neutral and it should be bullish or bearish in the current grid regime, the model will recommend a long half position or a short half position. Max longs get cut to half longs when the 14-day RSI is above 75. So for example, India fits that criteria here. It's only a long half position, even though it's bullish, and it should be bullish in Goldilocks because there's a tactical risk management overlay embedded into this table as well. Half longs get cut to no position when the 14-day RSI is above 75. I don't think anything currently fits that mode here today. Max shorts and half shorts get cut to no position when the 14-day RSI is below 35. And so that's obviously to account for the fact that shorts tend to be a lot more asymmetric, i.e. you tend to have more Novembers after markets go down for 3 months. Markets take the stairs down, markets take the stairs up and the elevator down. Bull markets take the stairs up and the elevator down. Bear markets take the stairs down and the elevator up. And so that's we want to make sure that we're incorporating that anecdotal knowledge and that institutional knowledge into this table as well. So again, what this table is designed to do is help you understand that, okay, maybe I don't want to follow along with KISS, but maybe I want to implement a customized version of KISS, because I do believe that what KISS really represents from when we say that is making sure that you're systematic about your top-down and bottom-up risk management overlay processes. I just think that if you learn nothing from 42 macro and your experience, with our service, it's that you need to be systematic about your research. And being systematic about your research means you're looking at the same exact data over and over and over and over every day, every week, every month, so you can spot critical inflections in real time, as opposed to just going down a rabbit hole and doing a bunch of research on a topic that makes you feel good and then putting positions on. That's what most people do. That's a terrible way to invest. You will not make it on the buy side if that's how you're investing. So what we're trying to do is take what we think are best practices from our buy side clients and put those in front of you and help educate the masses in terms of how to think about investing. And again, we don't necessarily believe we have the best process, but this is the best process that we can create based on everything that I've learned throughout my career thus far. And then secondarily, being systematic about your risk management means that you're creating rules, and more importantly, you're sticking to those rules. And we obviously think the rules that we've embedded into KISS, vis-a-vis the top-down and bottom-up risk management overlay, as indicated by those back tests and indicated by our continued growth of our business, those things are working. So just again, getting back to this table, if you want to implement KISS, or implement some version of that, you can use this table, because ultimately we have all the information that you need to incorporate the bottom-up risk management overlay vis-a-vis the volatility adjusted momentum signal, and then obviously the weather model signal, which we'll talk about in a few slides. Those will be the same for each asset class. So hopefully everyone's got some joy out of this. We use our volatility adjusted momentum signal to determine which exposures are most likely to perform as expected in the current regime. And so again, we made a pretty important statement here that I think is important to unpack, in line with how it should trade in the current grid regime. And so if we change the grid regime, then the actions will change. If we went into a risk-off regime like inflation or deflation, then the actions will change for most of these securities. Right now, the action corresponds to the current top-down market regime, which again we believe investors should orient their portfolios to. So if the regime changes, then the actions will change. And so in terms of how we determine how something should, quote unquote, should trade in the regime, it's based on a combination of our grid asset market backtesting process. We backtested everything that ticks in asset markets through the lens of our grid regime process, our bottom-up macro regime forecasting process. And then we also have just systematic institutional knowledge from watching asset markets and trading asset markets throughout my career. So it's a combination of that hard data and that soft experience that determines how these assets should trade. But ultimately, I think there's just trust that we know what we're doing here in terms of all in this process. And then lastly, just transitioning to our research that we pump out for our institutional audience. Obviously, I think to my knowledge, we're the only firm in the world that sells the same content to the retail and institutional investor. And more importantly, I think we're the only firm in the world that sells the same content to the retail and institutional investor at price points that retail investors can afford. We actually want to democratize finance. We don't just want to get rich pretending to democratize finance. We actually want to democratize finance because we understand that these institutional tools, this institutional knowledge of how to think about research, how to conduct risk management, how to be systematic and dispassionate about investing, as opposed to emotional and reactive and just confirmation bias and all those things that we tend to succumb to as puny humans with our puny human brains. What we're trying to do is take the best from my traveling around the world for 15 years, meeting with all the best investors in the world, not all, but many of the best investors in the world, taking notes, learning, having great discussions, great debates, and ultimately trying to create what we think is the best macro risk management process available for investors at this price point on Wall Street.